Hi, I am John from OG John AG Extra. This wasn't fundamentals. This was forced behavior. A 4-digit silver price sounds absurd in a stable system. It sounds like fantasy anchored to fear, the kind of prediction that gets dismissed in polite financial circles and ridiculed on mainstream financial television. But markets do not move on belief. They move on margin rules, collateral demands, and positioning stress. They move on the mechanics that happen behind the scenes, in the clearinghouses, in the risk management departments, in the split-second decisions made by algorithms that don't care about your thesis or your conviction. Now, when liquidity fractures, price doesn't drift higher politely. It reprices abruptly. It gaps. It moves in ways that violate every expectation built during calm periods. If the recent volatility made you uneasy, that reaction is not weakness. It is awareness. Nausea in markets usually signals instability beneath the surface, a primal recognition that something fundamental has shifted in the structure itself. Repricing events begin when paper promises multiply faster than deliverable supply. That imbalance does not resolve emotionally. It resolves mechanically, through forced liquidations, through margin calls, through the sudden disappearance of offers in the order book. This is not a prediction of a number. It is a conditional pathway built on stress dynamics, on observable mechanics that have played out in other markets during other stress episodes. We are entering a decision window. The next 2 to 3 weeks will reveal whether the recent volatility was simply noise or the beginning of a structural shift. In a minute, I'll show you the one signal that determines direction, the metric that separates theatrical price movement from genuine repricing. We measure stress points. We don't chase numbers. We don't get seduced by green candles or terrified by red ones. We watch the machinery beneath the price action. So what actually happened? Let's strip away the commentary and focus on mechanics. Do mechanics trigger? What actually shifted was not retail enthusiasm or a viral narrative. It was positioning stress inside the futures market. Leveraged longs increased exposure into strength, while commercial participants maintained sizable short positions, creating a crowded structure on both sides. At the same time, open interest expanded as available registered inventory drifted lower. That combination matters more than most people realize. It's not just a statistical curiosity, it's a structural vulnerability. Fact: when paper claims per ounce rise while deliverable supply tightens, sensitivity increases dramatically. Every additional contract represents a potential claim on physical metal that may not exist in easily accessible form. The market becomes unstable to relatively small shocks. A piece of news that would have moved price 2% in a stable structure now moves at 8%. A modest delivery request that would have been absorbed quietly now creates scrambling. Delivery notices began trending higher relative to shrinking registered stocks, signaling that more participants were standing for metal rather than rolling contracts forward. This is significant. In normal conditions, the vast majority of futures contracts are simply rolled forward, extended into the next month, treated as purely financial instruments. But when participants start demanding physical delivery, it transforms the nature of the contract from abstract financial claim to concrete physical obligation. Layer onto that a backdrop of dollar liquidity tightening and bond volatility, which stresses collateral across the system. This is where the interconnected nature of modern financial markets becomes critical. Silver doesn't trade in isolation. It trades as part of a vast web of collateral relationships. If yields move sharply, margin requirements adjust. When margin requirements adjust, weaker hands must either post additional capital or reduce exposure. That reduction is rarely orderly. It happens in clusters, in cascades, in moments of maximum stress when liquidity is already thin. Industrial demand quietly continues in the background. Solar manufacturing, electronics, and electric vehicle supply chains do not pause for futures volatility. They absorb float steadily, removing metal from the system at a consistent pace regardless of what's happening in the paper market. Meanwhile, ETF inflows can create headline demand, while physical withdrawals from vaults tell a different story about availability. Price spikes do not begin because buyers cheer. They begin because sellers hesitate or disappear under collateral pressure. The bid-ask spread widens, offers vanish from the screen, and suddenly the market discovers that liquidity was thinner than anyone realized. Wait until you see what happens when open interest rises while inventories fall. The next 14 days could determine whether this evolves into structural stress or simply reverts to range-bound noise. When leverage meets scarcity, price doesn't negotiate, it reprices. The reason recent movements felt violent has less to do with fundamental value and more to do with liquidity structure. In thin conditions, Order books are shallow. There aren't layers of patient buyers and sellers waiting at every price level. When volume hits a shallow book, price moves farther than logic would suggest. That is not manipulation, though it often feels like it. It is structure. Algorithmic systems then detect momentum and amplify it, accelerating both downside and upside within seconds. High-frequency trading algorithms don't analyze fundamentals. They detect patterns, velocity, order flow imbalances, and they act on them in microseconds. The move feeds itself, creating a feedback loop that can exhaust itself just as quickly as it began. When volatility rises, margin clerks do not debate narratives. They calculate exposure using standardized risk models. If collateral values fall or volatility spikes, margin requirements increase automatically. Traders who cannot post additional capital must reduce positions immediately. Those reductions happen at the worst possible time, at the exact moment when selling pressure is already elevated. That is forced selling. It does not ask whether the long-term thesis remains intact. It doesn't care about your conviction or your research. It simply closes risk according to pre-programmed rules. Stop-loss orders add fuel to this dynamic. Once triggered, they convert intention into market orders, creating cascades that resemble panic but are actually mechanical reactions to preset thresholds. Large funds also de-risk simultaneously when bond yields swing or equity markets wobble because risk models are correlated across assets. When the S&P 500 drops 3%, risk management systems across the financial system start reducing exposure in everything from copper to silver to emerging market bonds. Silver becomes collateral damage in a broader deleveraging event. The market just showed its teeth, and those teeth are sharper than most participants expected. Psychologically, this phase is exhausting. It is designed, not conspiratorially but structurally, to keep you staring at every tick, questioning conviction, second-guessing every decision. But volatility in this context is not random hostility. It is a symptom of stress in collateral markets, a visible manifestation of invisible pressures building throughout the financial system. Here's what matters next. Forced sellers eventually run out. They have finite positions. Once those positions are closed, once the margin calls are met or the accounts are liquidated, the pressure changes character. But here's what changes when forced sellers are gone. There's a phase, often brief, where volatility compresses right before vertical expansion. The market goes quiet, price ranges narrow. Observers assume the excitement is over, but that compression is often the final stage before a major move. Volatility isn't chaos. It's leverage being flushed from the system. And once that flush is complete, the market can move with surprising speed in the opposite direction. Now we separate signal from story using what I call the credibility ladder. We climb from verifiable facts to reasonable interpretations without jumping to conclusions. Fact: COMEX registered inventories have been trending lower relative to recent history. This is observable, measurable, publicly reported data. Interpretation: a tighter float means the market becomes more sensitive to shifts in delivery demand. That does not guarantee shortage. It increases fragility. The same delivery request that would have been absorbed without comment 2 years ago now creates measurable price impact. Fact: open interest remains elevated compared to prior quiet periods. Again, this is publicly available data updated daily. Interpretation: there are more paper claims per available ounce, which raises the potential impact of forced repositioning. Not destiny, just structure. Not certainty, just increased probability of volatile outcomes. Fact: retail premiums tend to spike during periods of stress. Coin dealers report difficulty sourcing inventory. Premiums over spot price expand from typical levels of $3–4 per ounce to $8 to $10 or higher. Interpretation: the supply chain between wholesale bars and retail coins strains under sudden demand. That reflects friction in the distribution system, not necessarily permanent scarcity. But friction matters. Friction creates price differentials, and persistent friction can signal deeper structural issues. Fact: margin requirements adjust upward when volatility expands. Exchanges publish these changes. They're not hidden. Interpretation: forced behavior increases because weaker hands must reduce exposure. Rules tighten when stress rises. This is automatic, mechanical, and predictable. What is not evidence of a 4-digit silver price? A single breakout candle, a trending hashtag, a dramatic headline on financial television, a passionate post from a precious metals enthusiast. Those are noise without structural confirmation. Price alone is insufficient evidence. This is probability stacking. We observe conditions, not fantasies. We look for confluences, for multiple independent indicators pointing toward the same conclusion. One of these facts matters more than the others. If two specific metrics align, if registered inventory drops sharply while delivery requests increase simultaneously, the math changes fundamentally. The paper market's ability to set price becomes questionable. Facts anchor us. Interpretation keeps us flexible. We hold both simultaneously without contradiction. This brings us to the decision zone, not a price target, a behavioral threshold. There's a multi-year resistance band overhead where prior advances failed and supply consistently appeared. That region, somewhere in the 32-35 range, depending on which contract you're measuring, is not magical. It is memory. Traders remember pain there. Institutions remember inventory there. Prior longs got liquidated at those levels. Prior shorts made profits at those levels. That creates reflexivity. When price approaches that band again, the reaction tells us more than the number itself. Psychological round numbers matter because participants anchor to them. $30, $50, eventually triple digits. These levels attract attention, and attention attracts orders. But the level itself is not the signal. The behavior at the level is the signal. If price pushes through resistance and volume expands alongside rising open interest, that suggests new participation rather than short covering alone. New money entering, new positions being established, not just old positions being closed. If price rises while open interest falls, that is often a fake breakout fueled by position reduction, not structural demand. Shorts covering, longs taking profits, no new conviction entering the market. A true washout looks different. It is a sharp spike lower on extreme volume, often accompanied by rising retail premiums and heightened volatility in bond yields or the dollar index. That divergence, paper price dropping while physical indicators tighten, signals stress rather than weakness in underlying demand. Correlation matters. If yields surge and silver drops in tandem, collateral stress may be driving behavior rather than anything specific to silver itself. We're in a decision window over the next 2 weeks. Reaction speed matters more than the level itself. Markets telegraph their intentions through behavior, not through price alone. There's one level where the shorts lose control. If we stall just below resistance, expect engineered exhaustion, a final shakeout designed to clear weak longs before the real move begins. Levels don't matter in isolation. Behavior at levels does. Now we address the divide most people sense but rarely quantify: paper price versus physical strain. The futures price, often called spot, reflects the most active contract trading in leveraged markets. It's determined by traders who may never touch physical metal, who are simply trading price exposure. The retail coin price reflects fabrication costs, distribution friction, and immediate availability. It's what you actually pay when you want metal in your hand. In calm conditions, the gap between the two remains modest, perhaps $2 to $4 per ounce over spot. During stress, that gap widens dramatically, sometimes to $10, $15 or more. Premium expansion is not random. It signals strain in sourcing and distribution. It means dealers are having difficulty acquiring inventory to meet retail demand. It means the connection between the paper market and the physical market is stretching. Registered inventory represents metal available for delivery against futures contracts. Eligible inventory is metal that meets exchange standards but is not committed for delivery. The distinction matters enormously. If registered stocks decline while open interest remains elevated, sensitivity increases. The ratio of claims to deliverable metal rises. Each contract represents a larger proportion of available supply. Delivery requests become a stress indicator because they convert paper exposure into physical obligation. When participants stand for delivery rather than rolling forward, they're saying, "I want the metal, not the financial exposure." That changes the game entirely. ETF share creation and redemption flows add another layer of complexity. Large inflows can imply demand, but if physical withdrawals from vaults accelerate simultaneously, that suggests metal is moving out of easily accessible pools and into private hands where it won't return to the market quickly. Industrial users complicate the picture further. Solar manufacturers and electronics firms lock forward contracts quietly, securing supply months or years in advance. Retail investors hoard visibly, posting pictures of their stacks on social media. Both remove float, but at different speeds and with different persistence. History shows episodes where futures price stalled or even declined, while premiums climbed steadily. That divergence did not resolve immediately. It built pressure, sometimes for months, until something finally gave way. Physical drain is rarely the initial spark for major moves. It is the slow fuse beneath the structure, invisible until the moment it reaches the powder keg. If premiums rise while price stalls, something is brewing beneath the surface. The real tell isn't price. It's delivery behavior. Paper trades fast. Physical moves slow, then suddenly. So when we talk about four-digit silver, understand what we are actually discussing. Not hype, not fantasy, a stress outcome, a repricing event that would only occur if structural pressure inside the paper market collides with tightening physical supply. It is conditional, it is not guaranteed. The pathway depends on behavior, not hope. Now I want your assessment. Do you think the next major move is more likely to come from a physical drain that slowly tightens the system, or from a sudden liquidity shock that forces rapid repositioning? And if we do see volatility expand again, would you prefer a sharp washout to reset leverage first, or a straight breakout through resistance? I drop your thoughts in the comments, because the next 2 weeks will reveal whether we're looking at noise or the beginning of something structural. We will continue monitoring the signals we outlined, calmly and without emotion. If this framework helps you think clearly during volatility, subscribe and stay with us as this decision window unfolds. Because if we get another margin hike while price stabilizes, the next move could be faster than anything we've seen in the past decade. The mechanics are in place. The question is only timing and trigger. Stay sharp, stay disciplined, and we'll see you in the next one.